Video for project, part 2. In this part, we're going to go through adjusting entries. So we have finished all the regular journal entries. Now it's a fiscal year end, and we're going to make adjusting entries. Adjusting entries is not a purchase, neither it's a sale. There's no cash involved. So the only place we're going to record adjusting entries is in the general journal worksheet. Alright, so before we make adjusting entries, we're going to finish this part, the trial balance, but I'm going to explain trial balance in the next video. Okay, so we can go through adjusting entries first. So we have the following adjusting entries. First, we're going to provide bad debt expense, charge bad debt expense, okay, equal to 2.7% of net credit sale. Net credit sale. So the key here is to find out what is my net credit sale. Okay, so what is net credit sale? Net credit sale, let's go to the general ledger. Net credit sale equals what? Equals sales revenue minus any sales return allowance minus any sales discount, and then minus any cash sales. It's going to give us net credit sales. Okay. Remember, we have only 2 cash sales in December. So what we can do is we're going to, after we post all the numbers into the ledger, we're going to use ending balance from sales revenue minus any cash sales minus ending balance of sales return allowance minus any sales discount, any balance, and multiply by the 2.7%. 2.7%. Okay. And this number will be well above $100,000. Well above $100,000. Okay. And part B, we have inventory count, and we have 760 supplies on hand. So we need adjusting entries to record our supply expense. Okay, basically we need a general ledger again. We're going to find a supply account. Of course, after we post all the numbers, we have a supply ending balance, but that's not the supply on hand. Okay, so we're going to make adjusting entries. We're going to debit supply expense, credit supplies. Okay, we're going to post a credit number here, making the ending balance equals 760. That's part B. And part C, we're going to adjusting the prepaid insurance. Okay, the prepaid insurance has beginning balance $3,300, which covers period January 1st through August 31st, 2018. So by the end of 2018, this $3,300 prepaid insurance will be expensed. Now this amount will be expensed for sure. In addition to that, okay, We also paid $6,900 to cover August through to cover September through next year August. Okay, therefore, part of the $6,900 will also be expensed. That is, the payment for September through December will be expensed. Then how to record the expense? Based on the rule, the company estimated 50% of the premium are attributable to the general activities. So we're going to debit insurance expense, and 50% will cover selling activities. We're going to debit miscellaneous expense. So basically, we're going to expense the full amount of old prepaid insurance and part of the new prepaid insurance, and debit insurance expense and debit miscellaneous expense on a 50 to 50% ratio. Okay, part D. The payroll summary for employees. Alright, so this is the accrual accounting. We're gonna, although it's not a salary day, but we need to accrue expenses, okay, for the year 2018, and this amount will be paid in 2019. Right, we have seen these already. Basically, we're going to follow the regular payroll journal entries. We debit salary, wages, expense, right? Credit, payable, and we will credit this salary and wage payable. Okay. Again, we're going to match the FIC tax again, and credit another FIC tax payable. That's part E. Part F. Okay, this is for interest expense. We have multiple transactions right here. First, interest has accrued at 7% on long-term notes payable since July the 1st, 2018. Okay, so we're going to calculate interest expense for long-term notes payable. Where's my long-term notes payable? Let's take a look. Long-term notes payables right here. Okay, we have this long-term notes payable, and the balance, right, as of July the 1st is $123,000, and I don't think we have any change in this balance. We don't have any transactions associated with long-term notes payable. So by the end of the year, we should have the similar balance, and then we're going to calculate 7% of that. Okay, and you have to divide it by 2 because we are calculating interest expense from July to December, okay, for half a year. Journal entry, debit interest expense, and we credit interest payable, okay, interest payable, because we are accruing this expense. That's the first interest expense in part F. And then second one, interest on bonds is accrued and paid semi-annually, 4% annual coupon rate. The next interest payment date is due January 1st, 2019. Okay, the bonds are dated January 1st, 2012, and mature January 1st, 2022. Market interest rate was 6%. Right, so this is bond question. This is the bond question. And the semi-annual interest payment. So December 31st, we're going to accrue the interest payment for the January 1st, the next year. But basically, all the numbers will be the same. So we can just do, how are we going to do it? Right, if you remember, we have a very similar homework assignment. Very similar homework assignment. So what is the 2018 December 31st interest expense? Right? The interest expense is determined by the carrying value of the bond. So we have original cost, and we have the unamortized discount bonds payable. So this amount is unamortized bonds payable. If we multiply this by 3%, which is the market rate 6% divided by 2, because we are doing six months interest. The interest expense we are about to record will be $7,736. And then what is my interest payment? And this is not cash yet, because we are going to pay the next day, the next year. So it becomes interest payable, right? It's determined by the coupon rate. Coupon rate and my face value. Coupon rate, annual rate 4%, but we're talking about 6 months, so it's 2%. The difference between these two, right? It's going to be the amortization of the discount on bonds payable. Discount on bonds payable. So this is the journal entry we're gonna record in part F. Or you can do the we have enough information for you to finish the amortization table. You can do an amortization table from 2019 through 2012, right? For some annual, and you're gonna find the same number. Okay, so this is the bond right here. G, interest accrued. Okay, we have other interest accrued. We have, I remember we have these for notes receivable, right? We have these notes receivables, and the number has been given already, actually. Let me see. This is interest accrued, notes receivable. Okay, notes receivable. So it's not interest expense anymore, right? For notes receivable, if we receive interest, that's our revenue. So the journal entry right here, we're gonna debit, right? Interest receivable, then credit interest revenue, $1,236. That's about interest revenue. And here, this one, interest accrued on notes payable, current notes payable. This amount is my interest expense. So we're gonna accrue interest expense. We're gonna debit interest expense $1,250 and credit interest payable. Okay, so these are about interest expenses and interest revenues. And part H, warehouse lease payment $8,400 was made. Okay, so it's a prepaid rental. Prepaid rental, that's from September 1st to the next year, February, the end of February. So how many months? So that's about 6 months, right? So we prepaid 6 months warehouse rent, and by the end of the year, we're gonna expense 4 months from September to December. Okay, so we're gonna expense 2/3 of $8,400. Okay, and also, if you check the general ledger, the prepaid rent account, we have some existing balances, and all these are old. This include, first of all, this balance is November 30th. So this balance already include the prepaid warehouse rent. So what is my old prepaid rent? Right, that's $17,010. $17,010 was my really old prepaid rent, and by the end of the year, they should be also expensed. So we expensed this amount and part of this amount. That is a total rent expense. We're going to report that we credit prepaid rent. Part H, I. $815 is owned to the company. $425 is owned to the city, and also utility bills, right? Utility bills. So basically, we're gonna debit utility expense and a credit accounts payables together. And part J, we have depreciation. Okay, depreciation. We have talked about depreciation for lift truck 1, right? We solved the depreciation and we reported the $350 journal entries. So lift 1 is down. But we're going to do buildings. We're going to do truck 1, 2, lift truck 2, 3, and office equipment computers. Okay, calculation, right? For buildings, we're going to use the sum of the year digit, right? Right, basically, that's 2014, July the 1st. So we're gonna do the first buildings. We're gonna do the depreciation table, right, for the sum of the year digit. So the first year is a partial year, right? First year is a partial year, and followed by second year is a full year. So this is a typical partial year sum of the year digit calculations, and you should be able to calculate what is my 2018, right? 2018 depreciation expense. And trucks are measured based on their usage, right? Actual usage. And the actual usage has been released right here. Truck 1, 12,000 miles. Truck 2, 16,000 miles. And we have the total estimated usage. So we can determine the 2018 depreciation. Truck 2, truck 3 are measured with the straight line method. Okay. Okay, when you do the calculation, make sure that although it does not affect 2018 depreciation, but the first year will be a half year depreciation according to the company's policy. And office equipment will be the straight line. Again, the first year will be half year depreciation. And computer is purchased December 19th, 2018. Purchased in the current year. And again, we're going to use a 50% half year depreciation. So we're going to use a double declining balance method, calculate for the first year depreciation and divide it by 2. That will be my computer's depreciation expense reported in 2018. So that's part J. Okay, so that's adjust entries we have. Okay, in the next videos, I'm going to briefly talk about trial balance.